Are you struggling with inconsistent results in your intraday trades? Have you entered the market too early, exited too late, or been caught in false breakouts? Then stop right now. This video will change the way you look at charts. We're going to decode the top 10 visual intraday trading strategies based on real market behavior, not just theory. Each image you'll see is a blueprint of proven entries, exits, and structure-based logic used by institutional traders. Whether you're trading Forex, stocks, or indices, these concepts are universal. Stay till the end because the last setup reveals a psychological trap most traders fall into. Let's dive deep and master intraday precision. This first setup reveals a crucial turning point in market structure, the reversal from bullish to bearish. Notice how the chart trends upward with higher highs and higher lows, signaling strength. But at the top, the market forms a double top, a classical reversal pattern. The second high fails to close above the first, showing exhaustion. You'll also observe a sharp bearish engulfing candle and a volume drop. This is not random. It signals smart money is exiting. From here, the price starts forming lower highs and lower lows, confirming the shift to a downtrend. As a trader, this is your cue to stop buying and start preparing for short opportunities with confirmation candles and tight risk management. Here we see a perfect price breakout continuation model. In intraday trading, price often ranges for some time. This box is where liquidity builds. Smart traders don't enter until price clearly breaks above the resistance of the range. The first entry is a breakout buy, but it carries slightly more risk due to potential false moves. The safer, high-probability entry is the pullback entry, when the market comes back to test the breakout zone as support. If that level holds and price creates bullish candles, you enter there. Why is this powerful? Because it confirms buyer strength and filters out fake-outs. Always combine breakout setups with volume spikes and momentum indicators for extra confirmation. This chart demonstrates a professional technique using VWAP, volume weighted average price, combined with the opening range high-low method. Right after the market opens, you define the range between the high and low of the first 15 to 30 minutes. Then track VWAP as your dynamic intraday mean. When price breaks above the opening range high and trades above VWAP with increasing volume, that's your confirmation to enter long. This strategy works best in trending sessions like London or New York. Look at how the consolidation forms near the high, volume dries up, and then suddenly spikes, triggering a breakout. Combine this with a tight stop below VWAP and you get a precise low-risk trade. The bullish flag is a powerhouse of intraday continuation strategies. It starts with a vertical price movement, forming the flagpole, driven by strong volume. Then price consolidates in a sloping rectangle or channel against the trend. This is the flag. Here, institutions take a breath, absorbing orders before the next move. You enter either at the bottom of the flag for early positioning or wait for the breakout candle above the flag high for confirmation. Your target? Measure the height of the flagpole and project it from the breakout point. This gives you an objective, high-probability take-profit zone. It's a clean and repeatable setup for momentum traders. In this image, we explore how to ride the trend with structured stop-loss and take profit. The market is clearly in a downtrend, forming lower lows. You wait for a minor pullback to a known resistance or pivot point. As price rejects that level with bearish candlesticks like shooting stars or engulfing candles, you enter short. Your stop loss goes just above that minor high to protect against whipsaw. The target is clearly defined at the next support level. This setup ensures a favorable risk-to-reward ratio and removes guesswork. The key is respecting structure. Support and resistance act like invisible walls guiding your trade path. Next up is the powerful divergence technique using the MACD. Price action shows a series of higher highs, but MACD doesn't follow. It prints lower highs instead. This is a red flag. Momentum is fading even though price is rising. This bearish divergence often leads to trend reversal or correction. Similarly, when price makes lower lows but MACD forms higher lows, you get a bullish divergence, often a precursor to an upside move. Entry is taken after a confirmation candle in the direction of divergence. This setup helps you avoid traps where indicators lie beneath price, revealing the real story, weakness or strength building up silently. We're intentionally revisiting the reversal pattern because it's the single most misinterpreted concept by beginners. A trend doesn't reverse randomly. It transitions through stages, momentum loss, consolidation, trap candles, and finally a decisive break in structure. This repeated pattern gives you confidence to act, not react. The more you study these phases, the better you get at anticipating market behavior and flipping your bias with the trend. Never ignore a potential reversal at the top. It's often the entry for your most profitable trades. This chart highlights an important survival tactic. Avoid trading in congestion. During intraday sessions, price often stalls in tight ranges, producing small indecisive candles. These zones are filled with noise, stop hunts, and fake-outs. Trading here results in frustration and losses. Instead, wait for a clear directional breakout with strong candle bodies and increased volume. Mark these zones as no-trade areas and be patient. Once the breakout comes, your entry has clarity and your stop loss has structure. Avoid the middle, trade the breakout. That's how pros operate. This setup shows a classic horizontal resistance breakout. Price has tested a level multiple times but failed to push through. Each test weakens the sellers. Once the final breakout occurs, price explodes. What makes this trade high quality is confirmation through volume surge and a clean breakout candle. Place your entry just above resistance and your stop loss inside the range. Once price moves into fresh territory, it often runs freely due to lack of historical supply. Use trailing stop or structure-based exits to lock profits as price trends upward. This final strategy reveals a market cycle most traders miss: volatility contraction and expansion. Markets don't move in a straight line, they pulse. Tight range consolidations, marked here in boxes, represent low volatility. These are periods of accumulation. Once price breaks out of these boxes, volatility explodes. This gives you a clean entry, predictable move, and momentum. Trade breakouts of these ranges with volume confirmation and a tight stop. It's one of the cleanest, no indicator needed strategies that even institutions use. Congratulations! You've now learned 10 high-probability intraday strategies with visual confirmation. These are not just setups, they're professional habits. The more you recognize these patterns, the more confident you become. So if you found this video valuable, hit like, click subscribe to Financial Freedom FX, and don't forget to comment your favorite setup below. More strategy breakdowns are coming. Until then, stay patient, stay disciplined, and trade smart.